You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is President and CEO of PPR No Company, Dave Van Horn. David's chief responsibilities include the oversight of the company's strategic planning, business development, and fundraising functions. His expertise is derived from over 30 years of residential and commercial real estate experience as a licensed Pennsylvania realtor, investor, title company partner, and commercial fundraiser. In addition to his role as president and CEO, Dave's biggest passion is for teaching others how to build and preserve wealth. Dave is a co-founder and board member of Strategic Investor Alliance, a purposeful planning and networking group for accredited investors in the Philadelphia area. Dave is also a national speaker, author, and investment blogger on biggerpockets.com. And so, guys, I'm excited to share the candid conversation I had with David where we discuss a litany of important and exciting topics. But before we get on to it, I just have a few quick housekeeping items to run through. And the first announcement here, guys, it's been a long time coming, but I'm excited to announce that we're really putting the final pieces of the puzzle in place for our third mobile home park investment fund offering. And we expect to be live here in the next week. So take this as your special invitation to get on our priority notification list for when it goes live. Again, you probably heard me mention this the last couple of weeks. Well, it is going live next week. So you need to go over to sunrisecapitalinvestors.com and you can click on the Get Started Today button and just go ahead and fill out that short form to get placed on our email notification list. And we're working on a number of exciting off-market deals behind the scenes here and are very excited to be working with you hopefully sometime in the near future. And moving on here, guys, we recently launched our partnership program called Bring Kevin a Deal, and this is where I will pay you as much as $200,000 for any mobile home park or parking lot investment opportunity that is referred to me that I end up buying. Now, to learn more about this opportunity and to download my deal acquisition criteria guide, simply go to bringkevinadeal.com. Again, that's bringkevinadeal.com. And if you have an opportunity you'd like to discuss, you can actually submit it right there on the website, and I'll give you a shout within 24 hours to discuss it. Moving on here, guys, if you love what we're doing here at the Real Estate Investing for Cash Flow podcast, and you haven't done so already, please subscribe to the show so that you're made aware of all new episodes that come out. Also, leave a rating and review on iTunes or Stitcher Radio or wherever you might download and listen to this podcast at. The reviews really help us attract awesome guests such as Dave onto the show, so please do that if you haven't done so already. And then lastly here, guys, before we get on to it, Dave, I want to remind you of the free 30-minute phone call that I offer each and every Friday. Been doing it for years now. This is where you can jump on the phone with me and we can discuss everything and anything that your heart desires about real estate investing, okay? I've met hundreds of you over the years. I've had many just wonderful conversations. And again, it's a way for me to connect with our awesome listeners, and that's you. And really just share the passion that we both have for real estate investing, okay? So if you'd like to jump on that call with me, go to kevinbuck.com to sign up. Just one disclaimer, just please take a few moments and write down some detailed notes when you're making that appointment that you'd like to discuss during our call together. That way we can spend those 30 minutes as efficiently as possible. And so now, guys, without further ado, let's get on to the part of the show that you've been waiting for, which is our interview with Dave Van Horn. So here we go. Alrighty, guys, it's my honor to introduce my guest for today's show, President and CEO of PPR, a nationwide note investment firm, Dave Van Horn. Dave, how you doing today?
Hey, how you doing?
I'm doing
everything
fantastic.
well?
Yeah, everything is great, man. It's even better now that I've got you here. So, and it's been, I didn't look back to see which episode you're on, but I can say that it's been multiple years, at least two plus years. And so excited to get you back on here. Obviously, the world changes incredibly quickly. And two plus years in the real estate world, man, it's a long time, right? And so lots can happen in between that span. And so very excited to not only just catch up with you, but just really talk about your business. What major changes have occurred over time. Obviously, we're in a very unique time in this world today. We're coming up on an election, but not that. But we've got this pandemic that has been causing chaos, not just throughout the country, but the world. And so lots to talk about there as well. And so with that, Dave, what I love for you to do. For those folks that aren't familiar with you, can't see how they wouldn't be, because you're all over the place. You're everywhere I look. Bigger Pockets, podcasts. But for those that might just be living in a cave somewhere and they're not familiar with who you are and what it is you do, maybe take a few minutes and tell us a little more about yourself and a little bit about your note business.
Sure. Like you mentioned, I'm president and CEO of PPR Note Company, and we're entering our 13th year. I'm trying to think.
Wow.
Yeah. So we've been around a while, and we buy a lot of distressed mortgages nationwide, 1 to 4 family residential. And believe it or not, we're entering our buying season. So, the biggest economic indicator for our business is unemployment. And we buy distressed debt. And there's 4 main reasons people default, which is death, divorce, job loss, and medical. And obviously, unemployment is one of the big indicators for us. And we're at unprecedented levels of unemployment. So, not that that's a good thing for the country, but it does create a lot of distress, creates a lot of opportunity for our funds to go out and buy more product at better discounts. And we're already seeing margins starting to widen. So it's an interesting time for us.
I was going to say, is that distress even showing itself as of yet? Because obviously the unemployment rate is incredibly high. There's lots of folks that are still in that forbearance program, right? And so they've got some leeway there. In addition to that, the I call it the boosted Fed unemployment benefits. The additional $600 a week. There's lots of folks that are might be out of work, but they're making maybe equal to, or sometimes even more, sometimes less as well. But like they're enough money to for the average American to live on and to continue to pay their debts and put food on the table and things of that nature. So I'm surprised to hear that like the distress is already being seen from your side of the business. I mean,
how's that happen?
Yeah, and not necessarily how's that happen, but what's it look like today, and then we can maybe talk about a forecast of what you foresee occurring over the next 12 to 18 months as well.
Well, once you get past 6 months, it's tough, right? That's what the economists always say. We actually have one on staff, so he's always, once we go farther out, he gets a little weird. But no, I think for us, it's the capital markets. We're seeing securitization wind downs. We're also seeing like MRAs, lines of credit are being pulled. So that creates stress.
What's an MRA? Just need clarity.
It's like a
there.
revolving line of credit, for example, that you'll see different types of funds have to utilize, and then you'll see constraints or requirements or stricter requirements. And then now all of a sudden they're pulling their lines. So now they don't have the liquidity they used to. So it forces them into selling situations sometimes. So when we say distress, it doesn't necessarily mean on the homeowner level yet. Although that could come in the next 6 to 12 months where you'll start to see, it depends on how long things go and will everybody get rehired and how long will there be stimulus, So there's a lot going on there. There's a lot to unpack, right?
Yeah. I mean, are these pullbacks, are they just knee-jerk reactions? I mean, more temporary,
sometimes.
just to really pause and wait to see what ultimately is how this is going to play out?
Well, a lot of it's with the credit markets, the commercial markets. So they're really being impacted right now. And you might see that as well in your industry where I don't know if, the financing's changing. It could be. I don't know if you're seeing anything dramatic.
Surprisingly enough, and so I'll speak to agency debt, Fannie Mae and Freddie Mac. Historically, apartments and mobile home parks, at least in the residential side, have fared very well, or in the commercial side, they've fared very well during the last couple of downturns. Everyone needs affordable housing, right? And so the interesting thing that occurred over the past month is as we get updated rate sheets on a weekly basis, this has only happened like 2 times in history to where this is a Fannie Mae loan, where the actual rates are lower for manufactured housing than that of larger multifamily investments, which is it just really goes to show that they're very comfortable with that asset class and feel very secure in that investment space. So
interesting.
Yeah, it literally by about 25 to 30 basis points. So I mean, not a huge gap there, but still substantial enough to pay attention in any event. So again, I think that I keep saying that, we're not far enough, and I don't think that this is like a true barometer of really how this all unpacks and plays out. In our space, one of the, I guess one of the luxuries that we've been able to experience, the same goes with multifamily, are those folks that, that are in the, the workforce housing sector that might have lost their job where they were making, $30,000, $40,000, $50,000 a year, to where their unemployment benefits sometimes are even more than that of what they were making at their occupation. And so, up until this point in time, at least until the end of this month, when those additional, I don't know if they're going to extend them or not yet, but at this point, I don't think anything has been announced. Up until this point in time, those folks have had enough money to, pay their rent, to keep the roof over their head, to, put the food on the table, to basically keep up with their financial obligations. Time will tell what that really looks like, Dave, when that additional stimulus or unemployment benefit runs out and it goes back to whatever the norm is for that particular state, which for the most part isn't enough to really survive on. I mean, it's barely enough to probably put food on the table, let alone pay for the roof over your head and anything else that might come up in your day-to-day life. So I think time will tell. So it's going to be quite an interesting ride that we roll on here over the next 12 to 18 months. I do think that it will have to be held together. The glue will have to stay put until after the election occurs. And so,
and all bets are off.
I think so. What are your thoughts?
That's an interesting question. I mean, we haven't. I have a rental portfolio of my own locally, and I haven't really seen much change in rent collection. Now I have some government housing, but on the we have about 20. Maybe 25% of our portfolio is RPLs, RePerforming Loans. And we didn't see a major uptick in forbearance requests. We've just seen a modest, small percentage, really. We expected more, but we really didn't see it. Now, that could change over time, but what's kind of different about the mortgage space a little bit is that the missed payments don't go away. They kind of get added onto the back end with, interest or whatever. Mm-hmm. Whereas if you miss rent, I mean, I was a property manager for a while at a RE/MAX years ago. And, if you missed more than 2 months rent, you had a high probability of not collecting the catch up, unless you're in a higher end rentals with high credit score folks or something. If you're in that middle or, the B/C area, it was a lot tougher to collect. They didn't have a lot of assets to begin with typically. So it depends, it'll be interesting to see. I don't know. The housing market where I'm in the Philadelphia area, is still pretty brisk. My oldest son buying a house. He's on his fourth or fifth house now with multiple offers trying to get a property, and he's waiting to go to closing. Right. So it's a tough time to be a buyer right now. So, because it's still brisk. Now, I don't know. And, you're in Florida, I believe. And
same thing's happening here. Yeah.
It's an aggressive market for trying to be a buyer. So it's still a seller's market. Now, will that transition in the next 6 or 12 months? It very well could, I guess. But I think there is a shortage of supply of housing. Mm-hmm. You have very low rates. There's a lot of things driving this. There's a lot of family formation going on right now. So the demand's still pretty high for housing. Yeah.
Family formation because everyone's been stuck together in the house.
Yeah, that's a nice way. That's a nice way of saying that, right? It's will this be a baby boom, right? So.
Yeah, no, that's interesting. Very interesting perspective there. So I want to back up a little bit. You mentioned RPLs, reperforming loans, and so I'm assuming those were once distressed. You guys restructured them and got those borrowers back on track. Correct. Is that
yes?
Okay.
Yes.
Fantastic. What is how about the exit strategy on those reperforming loans? What does that life cycle look like in your business from distressed to restructured, reperforming, and then where's it go after that?
So there's probably a half a dozen exits. Probably one of the first things is it vacant or occupied? Most vacants, like for example, we buy a lot of we buy some reverse mortgages from HUD, which are called HECM loans. And the borrowers are deceased, so we're buying them vacant. And typically, it's like buying the property when you buy vacant. Now, if you're buying occupied, a certain percentage are going to remain, and by foreclosure time, a good percentage it is vacant. So we know how we're exiting through them. it's just like any other, we could sell it as is, we could fix and flip it, we can fix and rent it, all those different options. Most of the time we're exiting property from the foreclosure bid. So about 85 days after that is where we exit the bulk of the portfolio usually. If it's a modification, then it's a case where how long are we going to season the asset before we sell it? And a lot of times it depends how much capital we have on hand versus, how many do we want to sell. So we have a barometer there where we're managing cash flow. But a lot of times as seasoning, like say you have 12 months seasoning, the value of the asset goes up dramatically. Just like if equity were to go up in the property that's behind the loan. We call that phantom appreciation. It's not appreciation in the true sense of I bought a $100,000 house that 10 years later is worth $200,000. But there are things that make our asset class go up in value. And one is seasoning and one is, the equity behind it.
Got it. What does that secondary market look like for those loans that are seasoned, once the exit occurs? I mean, who are you selling them to? Yeah.
Very brisk. Yeah.
Who are you selling them to?
A lot of it could be sold through, we have a big retail outlet of our own. We probably have about 6,000, maybe 7,000 registered note buyers in our system. So we have quite a big audience.
One-offs, packages?
Yeah, that would buy one-offs. And then we also, most of what we sell is through trade desk in large trades because it's easier. And that could be off to anybody. It could be to other funds, other investors. There's all kinds of REITs, insurance companies buy this product. It's more common than you realize. People are looking for that type of. Okay. And what we're working on now is we just did we're in the middle of a pretty big JV where we'll be doing more securitizations. So we'll, put together a bunch of capital, get some institutional funding to marry with that, buy a larger portfolio, and in about 15, 18 months, securitize those assets. And that's basically like a cash out refi would be in your world.
Yeah. So right now we're talking about predominantly residential. I know before we started recording here, we briefly hit on the commercial space as well. And is that a place that you guys dabble in at current? I mean, do you ever
on the commercial side?
Yeah,
just personally, I'm a passive investor. I've been involved in sponsoring, and I've been involved in. I'm not today, but and then in past I've raised capital for commercial. I used to do mobile home. I used to do mobile home parks, storage centers, but today I just predominantly do the mortgage space because it's just a focus thing, really.
Yeah. The question was really regarding commercial distress notes, right?
Commercial distress notes. Yes, they do exist. Actually, there's a big fund local to me that's all they do is commercial notes up and down the coast. But it's a how do you say? In some ways, it's more risky because you really got to know that asset, right? If you're buying a distressed asset with a lot of money and so you really got to know what you're doing. And then it is tough to get access. I mean, they're a very large fund; they're in the billions, so they have a lot of clout. But it is an aggressive marketplace as well. There's just fewer players in that space. But it does exist. And a lot of times you'll see it with student housing, strip stores, all kinds of stuff, but it does exist. Yeah.
So we made mention of this COVID pandemic, and I know we've made some major shifts in our business. Thankfully, the timing couldn't have worked out better for us. We had decided at the beginning of the year that we were not going to extend our lease, which ended in March, at the end of March, on our office space. And so, we already had the wheels had already been in motion for many years. I mean, we use a lot of technology in our business as far as communication with our internal team, our external team. And so we were already very prepared to go virtual. And again, the timing just kind of worked in our favor there. And so, that was one of the big shifts that occurred in our business. How about yours? I mean, have you guys had to adapt and make some major changes over these last couple of months? And if so, what do they look like? And has there been any that have, very positively impacted your business?
Yeah, I mean, I think there's been a little of both. I have 30 employees, for example, and you are correct. We figured out we don't need our office. The good news is we didn't have to really lay anybody off. We had, we're fully functioning. We're not a retail shop, so it's not like customers come in our place, a business or anything,
Mm-hmm.
and everything we do is virtual. So we were very fortunate to be able to keep pretty much business as usual. The biggest hang up for us has been the closures or moratoriums, or some states are pretty much shut down due to COVID, or some of the courthouses are closed, or so some of our foreclosures are delayed, some of our revenue streams are delayed. One of the things we're doing is upticking our note sales to compensate for some of that, for example.
Mm-hmm.
So we're shifting gears, in areas, to increase revenue now in certain areas, because we know revenue will be slower in other areas or delayed. Most cases, it's just a delay for us. So you will see some impact of maybe holding costs a little bit, that type of thing. But we're trying to manage cash better, just like any other business.
Yep. How about your company culture? What have you guys done to really keep that intact, being that folks are working virtual now? I don't know if you fully have gone away from the office and everyone's working from home at this point, or what.
Yeah.
But 30 employees, that's a decent number to go from 30 people working underneath one roof to, majority or all being virtual. And so how do you keep that glue, the stickiness together, the team, with everyone working from their homes and home offices, probably some with kids running around and screaming and all the other craziness that's come out of this pandemic?
I think a lot of it's just, we already were using a lot of Zoom. We're using a lot more, obviously, and Slack, things like that. We have a lot of huddles. We have had employee happy hours and all kinds of stuff. I have an HR guy. He does a pretty amazing job at trying to keep that culture intact. But to your point, it's not easy. In some ways, we're getting more work done, but you are missing the camaraderie stuff where, 6 of us can get in a conference room with a whiteboard. You kind of miss that,
Yes.
You can't really, it's hard to do that. So some of that stuff's tough. But we're trying. We used to do a lot of charity work together, and we used to have company barbecues and things like that, and ball games. We're missing all that stuff, which the fun stuff that we would do a lot of times. So it has been a little bit challenging that way.
Yeah, no, I definitely I miss the just the being able to get together and powwow and sit at the conference table, with the whiteboard and just brainstorm, brain dump ideas. And I haven't figured out how to do that virtually yet. It's just I'm sure there's some apps out there that are somewhat effective, but I not the same dynamic as being in a room together with the rest of your team, or select folks from your team. But hopefully we'll figure that out over time, or at least get back to a situation where we can comfortably meet, in larger groups and not have to worry about ending up in the hospital. So hopefully in future months.
We have polled our staff, and because we're getting ready to go back to the office, right?
Okay.
And, I don't think anybody wants to come back 5 days a week, which is interesting. And I think we're okay with it because we saw how much we were able to execute without being in the office. So I think it'll be a scaled back version, whether that's 1 day a week or 2 days a week. And our company meetings may be a rotation of some sort. And then, of course, we got to space everybody out, So it'll be an interesting, it's not going to be the same, whatever it is.
Be the new norm. That's what they say, right?
I hate the new normal, but
let's talk about PPR. I know that you guys have a few different investment offerings. At current, you've had a lot over the years, different offerings that you've put out there. Currently, you have a couple of different income funds, and then you've got what's called a liquidity fund. Would you mind sharing kind of the particulars of each one of those offerings and how they differ from one another?
Sure. It's just like how you look at all the alternative investments out there, we kind of fit into our niche, right? And one of the things that's unique about the note business, there's things we don't have and things we do have. For example, we don't have depreciation.
Right.
We'll never have that, right? There's nothing we can do about that. But we do have something called liquidity, whereas a lot of longer term investments don't. So we can kind of fit into a void or a niche for alternative investors who want to be in a longer term funds for some reasons, or they want to be in certain funds for tax reasons, or they want to be in shorter term funds like a hard money fund or a tax lien fund. We just happen to be a note fund, right? Mm-hmm. And what's kind of unique about us is because we do have liquidity, we can offer shorter terms, and we, Granted, it's at a lower rate, but it's much better than a bank or a money market, those types of things. So we do have a liquidity fund, and right now we have a 6-month fund at 6%, which is pretty competitive. And then we have a 1-year fund in our income, 1-year option in our income fund at 8%, and we have a 3-year option at 10%. And all three of these funds have the ability to compound as well. So if you were to compound at our 10% rate for 3 years, you're actually making 11.6, which, if you do that in a qualified plan, that's not so bad, right?
No.
And we're backed by mortgages. So our income fund consists of non-performing, primarily first mortgages. And we get somewhere between 18 and 22% type category of execution on those. With junior liens, sometimes it's north of 30%. We just can't buy as many or get enough of them. And in our liquidity fund, most of the time we're investing in either RePerforming loans, which usually have a coupon north of 12, so that gives you color, that arbitrage spread there, or we can invest in hard money origination type products. So they're typically what we do with those types of funds. And that's why that fund has liquidity. It consists of these reperforming loans that can be sold relatively quickly. We can sell like reperforming loans on a one-off basis in about 15 minutes. We can package them up and sell them in quantity in a couple of days. So it's a lot different than selling houses, for example, because I do sell several hundred REOs a year, a couple hundred, which are single-family houses a year. Obviously, they take longer to sell. I can't sell. That's what kind of gives us that liquidity option that some people wonder, like, well, how can you do that? So.
Yeah. So in that liquidity fund, I know that it's a 6-month term, 6% annuum. Does that mean, does a investor have the ability, if they were 3 months into that fund, that they could get their capital back out? Is that help
no?
Me trying to clarify what you're.
Occasionally, we used to have a 60-day option, and then you could get it out with 60 days notice.
Got it.
But we regulate capital with our lowest, and that was a 4% fund. But we turn it on and off based on capital needs. And same way with our 10% fund, it's not always open. So we regulate our capital with our highest and lowest rates based on how much liquidity we have and how much capital we need at what rate. So we're constantly, it's funny, how investors move assets? We not only move assets, we move money. So sometimes we have expensive money, we replace with cheaper money, and vice versa. We're constantly moving money and assets, whereas some folks tend to focus more on moving just assets.
Got it.
They don't think about moving their money. So there are times where we regulate our capital, and a lot of times we have a capital call list. So if, say, our 10% fund were closed for 60 days or whatever, that list would build. And then if we had large pools to acquire, we would hit our capital call list first, and then later on the public or whatever that was. Not public, but our accredited investor audience. And it's just like it would be just like somebody has a buyer's list. We kind of have a money list. And what that means is we're not raising capital all the time for the sake of raising capital. We're raising capital as we deploy it.
When you need it. And you mentioned in the beginning that we're rolling into your buying season. Why is now your buying season? Is it a certain part of the year? Is it the part of the year that you want to work harder than the others? Or
Well, it's funny, I had a couple, newer investors. They would say things like, "Oh, well, it must be a dangerous time to buy. There's so much volatility in the market. You need to wait to calm down." I'm like, no, you don't understand. We've been on the sidelines for 8 years. This is our buying season. We're not sitting on the sidelines. This is when we buy. Like, no, that's not true in this case. So yes, they are correct in traditional markets, maybe with all that volatility, but not in this. We buy when it's time to buy. And the last great time to buy was after the 2008 crash. And the buying season there was probably, because there's a time lag, it's probably 2009 to 2012 where the bulk of the product came in. We're going to see something like that again. Whether it'll be as severe or how long, that's another story. There's definitely going to be some fallout. There's no question. It's just how much and when.
Yeah. And what do you do differently than what you're already doing now to prepare for, a potential, significant size fallout? I mean, are you armed and ready for whatever comes your way?
I believe so. We have a lot of systems in place. It's really just being able to buy better and buy more. So right now, what'll happen is, like up until pre-COVID, it was thin margins. Assets were expensive because real estate values were up. So we're in direct correlation to real estate values. So because real estate values were pretty much up across the country or back to where they were before the last crash, the margins weren't that wide. And what you're seeing right now is the margins are starting to widen. The prices are starting to get a little cheaper right now, and they are starting to trade back. Some sellers are in denial a little bit. They don't want to accept that price, but you can see what actually is trading back a little bit. You know why? And it makes sense, because if my timelines are longer because of moratoriums, I can't offer you the same, right? It just doesn't make sense. So how could I possibly give you the same dollar I was before? Now, for us, the opportunity be, what can we do to speed things up? For example, one of our things is we aggressively improved our deed in lieu program. So that expedites things. Vacant property purchasing, I can get through foreclosure quicker. There's different things that you can do. And you can also, we have a whole state-by-state foreclosure matrix and timeline and cost type matrix. Now, that's not my department. I'm in the fundraising side, but the smarter folks that work with me have all that. And believe it or not, that impacts acquisitions big time, based on what courthouses are closed, what the timelines are looking like,
Are there any states outside of the pandemic and kind of the government shutdown in certain areas? Are there any states that you just stay away from completely for whatever reason?
We own assets in all 50. Is there areas that are less favorable? Oh, sure. And there's areas that there's not as much product, like Wyoming, for example. There's not a lot of people.
Yeah, sure.
Hawaii is an expensive state. It's difficult to work there a little bit because time zones, what time are you trying to get a workout done with a borrower or something, because the time zones are so weird. New York, New Jersey, very long timelines, very expensive. So a lot of people, those assets trade back, though. They trade for less because of those. So the market does factor some of that in. They know those timelines are longer.
Yeah. Of those distressed assets that you purchase, what percentage, generally speaking, are you able to get reperforming again? What's kind of the rule of thumb? Assuming it's a senior lien, obviously a senior lien position.
It depends. It depends on the asset class. Like with junior liens that are current on the first, for example, you might get out of 42 out of 100. You'll get a favorable outcome. And some people go, well, how do you make any money doing that? But they don't realize you're making all your money on those 42 assets out of the 100, right? So it's like, I liken it to selling insurance, right? By age 65, out of all men, 36 are dead. We just don't know which 36. Or you get the idea.
Yeah.
It's kind of that model. It's statistical. First mortgages very much sticks and bricks, sort of like commercial space, very much sticks and bricks. Where it's more about geography, the property, the condition, that kind of thing. So it's all asset-based. Typically, you'll see stuff, there's no such thing as a general pool, but I'll go throw it out there. If you had a pool of 100 first, you might see where, 60% were occupied and the rest were vacant. And then by the time you got to foreclosure, half of the occupied would become vacant. So you might get 30, 40% modification, and, 60% would end up being vacant. That's just kind of it's really not a rule of thumb because it varies, but it gives you an idea. It gives you color.
No, that's good. No, absolutely. Now, talk to me about those that are listening in and, to what we're talking about here that are, are intrigued by what it is you do, your business. What obviously you've been doing it 13 years. You just, there's certain things that you just don't even think of, right? It's just like, second nature to you. However, if you were getting started over again, what advice would you give someone that was looking to kind of take their first step, stick their toe in the water in this space, obviously get educated. That's kind of a no-brainer. I know that you share a lot of great information, bigger pockets, you've written a ton of articles. I think you even got a few books out. I mean, you've got a lot of great information out there, right? So get educated. That's a good first starting point. But what is it thereafter? I mean, what's it look like for a new note investor getting into the space?
Well, I'm big on not losing your shirt in the beginning, right? And I'm also big on invest in what you know, right? So no one says you have to do it like I do it.
Yeah.
For example, everything that you can see in the room that you're sitting in was financed. Everything at some point was financed that you can see almost, unless it's a tree outside or something. Even that might have been financed. But you get what I mean? Everything in your house has been financed. So, there's all kinds of debt, student loan debt, auto debt, medical debt. I just happen to be in the mortgage space. Nobody says that I'm right. So I'll give you a perfect example of that. I have a buddy that was an HVAC guy. He was financing the install of heaters. At first I met with him and I said, hey, did you ever think of owning the company that does that? He goes, well, there is a company that does that. I go, yeah, I know. Did you ever think of owning that? Well, that's the note space, right? He could finance the heater. He was getting a decent deposit on the heater. He would finance the balance. He would get a service contract, increase the value of his business. If they didn't pay him, he could put a mechanic's lien on their house. Pretty safe thing, right? And he really built a lot of wealth with that. So when you think about it, and I had a dentist buddy did the same thing. I go, did you ever think of financing dental work? So that's what I mean by invest in what you know. And he did the same thing. And I saw him a couple of years ago and he said, you're not going to believe this. My dental finance company is worth more than my dental practice. Well, that's my point, right? You never know where this could lead, right? So no one says you have to do notes and mortgages like Dave. Now, if you do want to do notes and mortgages, there are safer ways to start, right? One of the ways that I started in the beginning was hard money lending. And a lot of times when I sold a property, at one point I had like 40 places of my own. If I sold a property to a buddy, a lot of times I would hold a second mortgage so that they could get in with like low money down, that type of stuff. So there's a lot of easy ways to get in through the seller financed note business. Now, today I'm in the institutional note space. If you want to invest easily in that regard, sure, you can go into a note fund. It may be open to accredited only. Some are open through crowdfunding, for example. So you can invest in Lending Club for $20, right? So it doesn't take a lot of capital or anything like that, depending where you're at, where you can invest in. Now, Lending Club's an unsecured note. It's a little different. And you're investing in a piece of a lot of little notes, right? So there's other ways to spread risk around and invest in the note business. So that's a note fund. And then you can also invest in RePerforming Loans. That's a safe place to start. If you venture into the non-performing note world, that's where it gets a little risky, a little more dangerous, but more potential upside. And the safer ways there are investing in equity assets or investing in first liens instead of junior liens or in, so there's some different ways there. And I also suggest shadow someone else or partner with someone else as opposed to just like going all in and losing your money. It's like anything, if you're playing guitar, you're going to hang out with other people playing guitar. You're going to take lessons, that kind of thing, and maybe get a coach or a mentor. Well, you can kind of do the same thing in this world too. You can, get someone else that's more experienced to walk you through the space, and then network with people. We have a group on LinkedIn called Distressed Mortgages Group, or, go on Bigger Pockets, and there's, note investing niche on there,
Okay, fantastic. No, I love every bit of it. So, guys, you write that down, right? Take Dave's advice. He's been there, done that, 13 plus years.
I've lost all the money
he's talking about.
I've done all that. You have to lose money to be successful. Yeah. It seems like, unfortunately.
Yeah, I've got a surprise section for you. I didn't warn you about this, and but it's good. It allows us to get a little bit more to the intimate side of Dave in your world. And so there's 6 questions I'm going to ask you, short questions. Just looking for 6 short, concise answers. I promise you, there's nothing weird or out of line here. So the first one, your biggest fear, what is it?
Probably regret.
Okay.
Yeah, my biggest fear is regret of not doing something, reaching for the reaching for something bigger,
Yeah.
Yeah.
Well, that ties
More afraid of regret than failure, I think.
Well, that ties perfectly into the second question, because that's what is your one biggest regret?
Probably that I didn't start earlier, or I didn't utilize leverage more.
Mm-hmm.
I had a coach for several years who would always tell me, Dave, what can you leverage in the next 6 to 12 months in your personal or business life that'll catapult you? And every time I'd circle back with him, he'd ask me the same stupid question. I'm only kidding. It was a good question. And what's interesting about that is it'll change for you over time. You might go one time and it's, hey, I need capital, or I need a partner, a JV partner. I need, technology, or I need, education or a virtual assistant, whatever that is. It's going to change. Something that'll catapult you. What can we leverage, and know what you're good at. I think it took me, I was probably 50 before I started to realize what I was good at. And when I realized, hey, focus on what you're good at and outsource the rest. Hey, how brilliant is that? So there's just certain things I've come to grips with that I'm just never going to be really good at that. And then there's other things that I'll kick your butt in, so.
I will say that you guys, and I don't know if you kind of spearheaded or not, but your company does a absolutely phenomenal job of putting out really high quality content, but not just that. It's the marketing approach you take to actually conveying your message to the world. I mean, it's a very professional image. Everything I've ever seen of yours has just been top notch. So again, I don't know if that's partially you, all you. Or,
I wish that was me. But, actually, it's mostly my son.
You write a lot of the content, though. I'm assuming, correct?
No, I do.
Yeah. So
and me and my son work together a lot, and he's kind of our brand ambassador.
Yeah.
And he's 30. He's kind of behind the scenes, but he was an English major and a writer, a script writer, and he helps me quite a bit.
Yeah, well, you guys do a great job there. And I wanted to ask you, you mentioned about the one biggest regret, not using more leverage. What was the biggest trepidation, when that mentor of yours kept, bringing that question back up again and again every 6 to 12 months? What was the trepidation that you had of why you didn't really want to push more leverage at that point in time?
Well, it's not always leverage in money. It could be leveraging how you're leveraging your time.
Yep.
It's your resources. It's really figuring out what you need, what's holding you back. I think there's always something holding all of us back at some point in life. A lot of times I came from modest background, right? So a lot of it was capital related. And it's kind of funny that, I was able to, solve some of that, right? So a lot of, I never had any capital, and a lot of the things that I thought would help me raise capital were dramatically different than what I thought. Like a perfect example of that would be, I thought it was the more people I knew would make raising capital easier. So I would be the old school networker, so to speak. When in reality, it's no, how many people know you? It's the opposite, right? So it's like. Yeah. Whereas like a podcast would help dramatically, or writing. I wasn't much of a podcast guy, but I just took a different platform, and there's no right or wrong. It could be YouTube, it could be whatever is your thing,
No, I love that's why I did a podcast. I'm a horrible writer. So yeah. How about moving on here to the third one? Most influential business book that you've read that has the biggest impact on your life.
Wow. There's so many, and I read so many books. I literally read like 5 books at a time. One, I'll just give you a couple I'm reading lately. It's by Mike Michalowicz. I don't know if you've heard of Profit First. He's got a new book out called Fix This Next. He had another good book called Clockwork, which was I'm familiar with how to manage your time, And Fix This Next is great for any business. Profit First is basically the pay yourself first concept, but it does change your focus on your business regardless of what your accountants are telling you. I'm sure you've seen cases where you go to your accountant and they go, oh, you made all this money this year, Kevin. And oh, by the way, you owe this much in taxes. And you're going, but I don't have any money in my account, right? Like how many of us can relate to that, right? So Profit First is the type of book that'll fix that for you very quickly. Yeah.
Okay. Fantastic. I'll be sure to put that in show notes, guys. And moving on to the next one here, Dave. Outside the daily work grind, what do you do to decompress?
I just got back from the mountains, actually.
Okay.
Yeah, a lot of times I go away and hide and shut off the technology and take the Facebook apps off the phone and all that kind of stuff. Do a little fishing. I like to play ping pong, and I have 4 grandkids, so I like my grandkids. And so, yeah, some of those. But reading's probably my biggest thing. I like to read a lot.
Okay.
Meditate a little.
Yeah, no, great stuff. Moving on here, 5th one, the one thing that you cannot live without. What would that be?
One thing I can't live without, besides your cell phone? Gosh, what can I not live without? Believe it or not, it's my NutriBullet, my shakes. I make my shakes with. So I always have a shake.
What's that?
Day.
A mini little blender or what? What's
a mini little blender.
Okay.
Like a NutriBlender.
Yeah. Gotcha.
Yeah. I don't know that I could live without that these days. So.
Last one here. What would your backup plan be if one day you just woke up and decided that you no longer wanted to, be in the note business? You no longer wanted to run your company, just really had a change of heart in the middle of the night. You had this vivid dream, and that vivid dream told you to do something different. What would that different be?
Wow. That's it would probably be something on the charity side. Because I realized that as investors, it would be one of the things I wish I had been able to do more of is, do like some of the startups you see today where they do a charitable component into their business. And I've done some of that over the years. I run an event, we donate proceeds to Project Home, which is the homeless, or but some of my rental properties too. I used to do some stuff with, battered women. I had housing. I have a recovery center, drug and alcohol recovery center. So I always think there's different things we could be doing with some of our stuff. So I don't know, I guess maybe more on the charitable side. I'm very good at raising capital. I think raising capital for the right charity would be kind of neat, because it would be something I already do. It would probably be easier than what I do because it's a purpose bigger than me, in that case. So I think that would probably be something at this stage for me, something worthwhile on the charity side, maybe housing related, because I'm a real estate guy.
Yeah, no, I love that. Do you have, I know that you guys already are involved in multiple different charitable endeavors. Is there someone that in your office, on your team, that typically helps spearhead and organize? I feel like that's probably one of the biggest challenges with, especially with growing companies is, there's millions of ideas, right? Millions of things you want to do as you're growing a company. There's things that need to be done and things that you want to get done, right? And it's really hard to organize and actually execute on all those different ideas. And you guys have a larger organization. I'm assuming there's probably someone there that helps spearhead some of those initiatives. Is that correct?
That is correct. And in a nutshell, this is what they do. Once a year, they take a vote on the charities for the upcoming year, and they have a charity per quarter. And then the whole team does something for that charity for that quarter, whether we go into the field and do something or we do some kind of other, fundraising activity or whatever that is. So we literally do every quarter, and the employees vote on those charities. So they'll suggest the top, 20, 25 charities. Because a lot of times there's so many good causes out there. I'm not saying one's better than another, but what's kind of neat about this is we let the staff pick. We let them chime in which ones, and then they have a vote, and then we pick the top ones.
That's great. I mean, then their heart's more directly aligned with it as well. I love that. It's a great idea. Fantastic. Well, Dave, this has been a lot of fun, man. It's always a pleasure catching up with you. I think the last time, if I can recall, we saw each other. Maybe, I don't know if you were in the podcast first, or I saw you at, I think, one of Joe Fairless's event at some point in time.
Denver.
Yeah, I can't recall if that was the first one or second one. I lose track of time here. But in any event, it's always good catching up with you. And for those folks that want to learn more about you and the different offerings you have and everything that your company has going on, where's the best place to find you?
Probably the easiest place is pprnoteco.com, which is our website, pprnoteco.com, or Bigger Pockets. I answer questions pretty much on a daily basis. And we do have, that LinkedIn group on distressed mortgages group on LinkedIn. Some people buy and sell assets there, ask questions. We answer questions there as well. So.
Okay, fantastic, guys. I'll be sure to put all that in the show notes as well. Put links to all the different groups that you've mentioned. And yeah, Dave, this has been a lot of fun, man. Really, really appreciate you coming back on and catching up, and wishing you and your family and your team and everyone else the best up there as we push through these challenging times. Although you did say that they're finally opening things back up in PA, and hopefully getting back to, again, I hate the word new normal. I know. Trying to get it out of my vocabulary.
It's the new abnormal.
I keep saying it. I'm like, stop saying that. I don't like that.
I appreciate you having me on. It was a lot of fun. And stay safe out there, right?
Yeah, you too. All right. Well, thank you, Dave. And guys, thank you for tuning into this week's show. And until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You guys take care now.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.